So Hanover Re as a group, we are a fairly new company compared to our peers. Our peers are 200 and 300 years old. We were established only in 1966. So by age, we are, or we might be even smaller than many of the regional companies here in the Gulf and in the MENA region. But over the years, I think Hanover Re has evolved, and today we rank number 3 in terms of premium income. And although it's not here on the presentation, we rank number 1 in terms of profitability for the past 5 to 7 years. Okay, so this slide shows you basically the evolution of Hanover Re. We started as a small reinsurance company in Germany, in a city called Hanover, which is a small city. It's not a large city like Hamburg or like Munich, but it's a green, beautiful, small city in Hanover. And today, this only shows you that our acquisitions and our expansion over the years. The operation in Bahrain started in 2006. And the last major acquisition made by Hanover Re Group was the acquisition of Argenta or Argenta Lloyd's Syndicate in 2018. This is the group structure. So here you'd see that Hanover Re as a group, it is owned by a financial holding company called Talanx Group. And the rest is free-floating ownership. You would see the ENC Rook, that is the German domestic insurer. In Germany, we would need to have a separate license for the domestic operation in Germany. And over the world, we've got more than 150 subsidiaries, branches, and rep offices. So we are well presented all over the world in all the continents. Again, those figures are from 2018. This just shows you the top 15 reinsurers in the world, and Hanover Re currently is number 3. In 2019, I think the figure will increase to about 22.5 billion US dollars in terms of gross written premium income. Just for you to know, the difference between the GWP is the gross written premium income, and the NWP is the net premium income. And just as an indication, the difference between the GWP and the NWP is what reinsurers spend on their own protection. Because even reinsurers, they buy, even the largest reinsurers, they still buy high level of reinsurance, or what we call retrocession. It could be from a traditional market, or could be from non-traditional capital market. Okay, so this is Hanover Re in the Middle East. So in the Middle East, we have been here since the 70s as a capacity provider, as a player in the market. But in 2006, the group decided that the MENA region is a strategic high growth market with significant potential, and they've decided to establish an operation here in Bahrain. And why Bahrain? Because of the proximity to all major markets in the region, predominantly or namely Saudi Arabia and the UAE, which are the 2 largest markets in our region. And in addition, the availability of local expertise and technical staff. And the third main factor was the regulatory regime. So back then in 2006, the Central Bank of Bahrain, or back then it used to call the Bahrain Monetary Agency, the BMA, was one of the most tested and oldest regulatory regimes in the region. Now, many other regulatory bodies like SAMA have emerged as well. But back then, one of the reasons for the establishment of the office is also the availability of a clear regulatory framework to establish an office in Bahrain. The office in Bahrain, or the operation in Bahrain, we're not a young company anymore, so we've been in the region for, in addition to 14 years physically in the region, we are the only reinsurer that has a physical presence in the region with full underwriting authority. So everything with the exception of specialty, like aviation, like credit, surety, like decennial liability, those are written centrally either in Hanover in Germany or elsewhere within the group. But all the traditional lines of business, property, engineering, casualty, liability, are written here in Bahrain. So the full underwriting authority, claims authority, accounts, finance, it all lies here in Bahrain. Yes, we asked the group for some advice on expertise in certain niche areas, but in terms of authority, I think we do understand our markets better than the group, and the group believes in full local empowerment. So, and over the years, what we've seen is we have seen a number of important milestones from the establishment of the office in 2006, okay, to date. So we've seen the Arab Spring in 2011, and that has affected the attractiveness of the region. But nevertheless, we have continued because we have a long-term vision, and we believe in the Gulf region in specific, and the wider MENA region, that this region has significant potential for growth. And we believe that with tighter regulation, that this region will fulfill its true potential. We've got all the ingredients for success, and I think it's a matter of time because we reach that point. In 2013, we have established a branch in Labuan. Okay, this is mainly to service the Malaysia market and the wider Southeast Asia market. Today, 2020, we're living in the days of the coronavirus, the COVID-19. Working from home has become the norm. This is the first time we conduct, in this region at least, an online training. Yes, we have had a number of meetings with our partners, a number of discussions, but an online training, I think this is the first time during the difficult times of 2020 that we do conduct an online training. And the credit here also goes to Eli and our partners in Chedid Re. 2020 and the coronavirus, yes, we live in a world of uncertainty. So nobody knows what is the actual impact of the coronavirus. Nobody knows what is the exact potential impact, the financial impact of the coronavirus. We've seen that many countries have been put on full lockdown. Many governments have taken strict measures to control the spread of the virus, and this will definitely have an impact on the business. This will definitely have an impact on the forecast. This would definitely have the impact on various budgets. We've seen a number of insurers and reinsurers as well worldwide. They have issued a profit warning, saying that because generally all listed companies, they issue a statement or what we call a market guidance to the public, to investors, that okay, as a group we'll be achieving this much net profit at the end of the year if the large loss budget is within a tolerable level. But because of the uncertainty nowadays, many companies have withdrawn the profit guidance given for the year because they are unable to really quantify what would be the exact impact of the coronavirus. But would that have an impact on our commitment to the region? The answer is no. We're committed to the region. We believe in the region. We believe that the region has significant potential for growth, and the region has yet really, there are many indicators that really show that the region has yet to fully realize its true potential. So we're committed to the market, and we believe really in long-term partnership and transfer of knowledge, not only capacity but also knowledge to our partners in the market. This slide would show our presence or our mandate in the region. So basically, our core markets currently in terms of market size would be written in Bahrain, would be Saudi Arabia, followed by the UAE, Egypt, Kuwait, and other markets. So the two largest markets are Saudi Arabia and then followed by the UAE, and this is no surprise. Saudi is one of the largest countries in the region. Saudi is one of the strongest economies in the region. And despite that, if you look at the indicators, if you look at the insurance penetration in the region and in Saudi Arabia, the insurance penetration is still less than 2%. If we look at the worldwide average, then we're looking at an average of 7%. The insurance penetration is the insurance premium by the by the GDP of the country. So if you take the gross written premium, let's say of Saudi Arabia, 11 or 12 billion dollars, by the GDP of Saudi Arabia, which is around 700 billion dollars, this would give you the insurance penetration. And the insurance penetration is a good ratio to assess the development of the insurance industry in any country. So by looking at the current figure, and if we look at different slides as we go, the potential is still massive. Even the insurance penetration average in a continent like Africa is 2%. So our region really has significant potential for growth, and the potential is yet to be realized. So the future is there. We are true believers in this region, and we are true believers that our commitment to the market and our commitment to our partners during difficult times as well, because we've seen a number of major losses in the region. We've seen the effect even of climate change. Yeah, so heavy rains, floods across the region, but with corrective measures, with initiatives taken by many regulators, especially in Saudi Arabia, we're seeing that the market is still an attractive market to international reinsurers. International reinsurance capacity needs potential for growth, needs solid primary market, well-regulated primary market, and they need also clear guidelines. So no fluctuation in terms of inflation, steady economy, growing economy. This is what the international market is looking for, and all of this is available here in Saudi Arabia, and to a lesser extent in Bahrain and the wider Gulf and MENA region. Yes, so this slide shows you the reinsurance premium size. So how big is the reinsurance market? We've seen that Hanover writes about 21 billion euro, and the worldwide insurance market is about 230 billion. The global insurance market is a 4.3 trillion euro. About 25% of the worldwide market is the US market. So the US market is by large the largest market in the world, I think the gross written premium income in the US is about 1.2, 1.1 trillion. So that's about 25 quarter of the global insurance premium, but the Chinese market is catching up. So China has grown significantly over the years, and China have also outgrown markets like traditional markets like the UK, like Japan, and the Chinese market today is the second largest market in the world with premium income in excess of 450 billion euros. Why do we say that the region has potential? Now, if we take a small European country like, say, Holland, the Netherlands is a small country, but if we look at their gross written premium income, I think the market gross written premium income is in the region of 80 billion euros. And that's a very big amount compared to our region. So even if you take these two largest markets put together, they amount to about 25 billion. A small European market is still much bigger than our two largest markets in the region. What I'm trying to say is that the potential is really significant. Saudi Arabia is a G20 country. Saudi Arabia is now diversifying. If you look at the GDP of Saudi Arabia, about 40 to 45% is oil and gas. The Saudi government is now diversifying from oil and gas. So the contribution of other sectors to the GDP is really increasing. The regulator in Saudi Arabia, SAMA, is making or introducing a number of guidelines. Many lines of business are becoming compulsory. All of this will lead to a bigger premium income and a higher GDP. So the potential really for the region is really significant in our view. And this view is not only a textbook view. Otherwise, a group like Hanover would not have really invested heavily in this region. We've got about 50 people here in Bahrain servicing the region, because we believe that with the right corrective measures, this region is still a maturing market. It's an emerging market, so it has not matured yet, but the whole region is moving towards tighter regulation, and tighter regulation means more demand for reinsurance. Okay, so let's talk about the basics. Now, when we talk about insurance, we always refer to risk. So risk, in terms of definition, risk is a form of uncertainty. So we've got uncertain outcome to a given situation. So an event might occur and the outcome might not be really favorable to us. Okay. We have a possibility of a loss. So all of that is a definition of risk. Nobody knows the future. Okay. Nobody could predict the future, what is going to happen next. And hence there is always a residual risk no matter what we do. So the word risk itself, it could mean many things. It could mean a likelihood. It could mean the probability. We could use risk as a probability, or we could use risk as an object. In our insurance field, when we refer to a risk, this risk is good or that risk is bad. This risk is underpriced or that risk is adequately priced. The term risk refers to the subject matter of insurance. So it refers to a building, it refers to a car, it refers to a portfolio in case of a treaty reinsurance. It refers always to the subject matter of insurance. It could even in life insurance, it could refer to a life portfolio, it could refer to an individual risk, an individual person. A risk could also mean a peril. So when we say risk, it could mean a peril, be it theft, cyclone, malicious damage, fire, business interruption, contingent business interruption. All of that falls under the wider definition of risk. Later on, we'll see now what are the types of risks. So risk, we've got two main types of risk. So we've got the speculative risk. Okay, speculative risk is the risk where there is a potential for gain and a potential for loss. Okay, so it's like gambling. When you gamble with a 10 euro, you have a potential to double that amount or to lose it. Okay, so that is a speculative risk. Okay, and if you look at the definition, speculative risk exists where there is either a chance of loss or a chance of profit. There are two possible outcomes, gain or loss. So those risks are not really insurable risks. The insurable risk would be the pure risk. Okay, so the pure risk entails that the chance of loss but no chance of profit. So it's either you have an accident or you don't have an accident. It's either your house goes on fire or doesn't go on fire. It's either the property that you work in or the property that you own gets get a fire or a theft, or it doesn't. It's either there's a flood tomorrow or there is no flood. So there is no chance of gain. Even if there is no flood or no fire, you don't gain anything, but you remain in the same position that you enjoy. So this is the pure risk, is the risk that is insurable and the risk that we use in insurance. Okay, so there are many definitions of risk, but I think the most comprehensive definition that I have seen is that risk can be defined as the combination of probability and severity should an event occur. Probability is the probability or a chance that this risk will happen, probability of fire, probability of a flood, probability of typhoon, probability of heavy rain, probability of a person having an accident, a car accident, and the severity. The severity would be, should the loss occur, should a fire occur, how much would the fire damage? Would it damage, let's say, one floor of 10-story building? Would it damage 2 floors? Would it be a total claim? Would it damage the whole property? This would be the severity should a claim occur. So combination of the probability and severity should a claim occur. This would be, I think, the most comprehensive definition of risk in insurance terms. The example that we're giving, likelihood of a fire in a house and the consequential damage to the house should the fire occur, exactly what we said. If an event occurs, okay, how much or how big, in simple words, how big would the damage be? So if we have a risk and we establish that the risk is there, how do we deal with risk? There are many ways to deal with risk. So risk avoidance, okay? Any particular activity, if somebody is, let's say, carries a personal accident insurance, okay, or a personal accident cover. If somebody fears, fears heights or fears flying in an airplane, he or she might choose not to fly. So the risk has been avoided altogether. So you are not risking an airplane crash by not flying on an airplane altogether. So here there is no risk as such. So you have avoided the risk altogether. The second potential treatment for any risk would be the risk control. So risk control involves reducing the severity of the claim or of the loss or the likelihood of the loss from occurring. Okay, so you control the risk. You could say, okay, you know what, in my house there's a potential for theft, so I'm gonna install CCTV cameras. I'm gonna install surveillance cameras. I will employ a watchman, and the risk would be reduced. Okay, or also, okay, if the risk is fire, then you could say, okay, you know what, I will use I would need to reduce the potential for fire, so no cooking inside the house, everything is done outside. I will do regular maintenance to the electricity of the house. I will use firefighting appliances. I will install them in the house and make sure that they do work, like fire extinguishers, smoke detectors, and the like. But I will not buy insurance. So in this case, the risk is controlled. The third possible treatment of risk would be the risk transfer. And the risk transfer is the ideal example, or the classical example would be insurance. So you transfer the risk altogether to a professional risk carrier, and the most common example would be an insurance company. So you have a risk of fire in a certain property. What do? You go and you buy an insurance cover, and then the risk is transferred from you, being the owner of this property, to the insurance company in exchange for a premium. We do see also many or other forms of risk transfer, like when you walk into a car park in a mall, you will always see those disclaimers, okay, that you're parking here at your own risk. Okay, so if there's any theft, any damage to the car, to your car, while it is parked at the mall has no liability whatsoever. So those are forms of also transferring the risk, or the mall management or the mall owner is transferring the risk of theft or of damage to cars of customers from the mall's management, okay, as this is something within their custody, and then they would own something that we call a duty of care to the by using those disclaimers. So those disclaimers, we see them a lot. Even if you take your clothes to the laundry, you'd see this. There's a small disclaimer that if there is a damage, blah blah blah, the laundry has no liability. So all of those are forms of really risk transfer, and insurance is the most common one. The last form of risk treatment would be the risk retention or risk financing. Okay, so if you're a corporate, if you manage a let's say a family business, you look at the claims over the years, and you'd say, okay, you know what, I have a total of, let's say, property claims of 100,000 over the past 3 years. Okay, so and I don't see the need. Okay, I don't see the need for me to go and transfer this risk to a professional risk carrier like an insurance company. I will retain the risk. Okay, I will finance the risk. So you would establish a pool. In older days, we see that many many corporates in the region, especially for medical, what they used to do is for medical insurance, they provide an in-house medical insurance or in-house medical coverage to their employees, i.e., if an employee has any illness or suffers from any disease or sickness, they go to the private sector, they get treated, and they bring the receipt to corporate or to their employer, and they will be reimbursed. They will be reimbursed from a fund. This fund is set by the company. So they are financing the risk, and this is also a form of risk treatment rather than buying an insurance coverage and paying premium to transfer the risk to a professional risk carrier. Okay, so insurance is, which is the most common way or form of risk treatment would be, as we said, would be insurance, and insurance would mean transferring the risk to an insurance company, a professional risk carrier, somebody who understands risk, and somebody who's able to pool many risks together in exchange for a premium. Okay, the premium always in insurance terms, the premium, we always say that the premium has to be an equitable premium, meaning the premium has to represent the degree of risk or the degree of hazard this brings to the pool of the insurance. So if you insure, that's a very simple example would be if you insure a sedan car, a normal family car, you pay a certain premium. If you go and you insure a super sports car, I don't know, Ferrari, Lamborghini, you pay at the premium with many loadings, because a sports car brings higher degree of risk to the pool of the insurance company. So the premium has to reflect the exposure. And also the financial protection against the loss arising out of the occurrence of an uncertain event. So this is what the insurance provide. Insurance always provide a financial protection. In insurance, the last point is insurance is nothing but a promise. In insurance, we don't sell really anything tangible. That's why I say in many emerging markets, the job of the insurance salesperson is very difficult if the line of business is not compulsory. So the consumer behavior is that if the line of business is not compulsory, if we don't have to buy insurance, we won't buy it. So selling insurance is not very easy. It's not the easiest job in the world, because you're not selling anything tangible. You're not selling anything. Nobody's gonna take an insurance policy and say, okay, I have an insurance cover, and go and show it to his friends. It doesn't work this way. So because what we sell is only a promise. As an insurance company, we sell a promise to the policyholder that should a loss occur, we will indemnify you, we will compensate you, we will put you in the same position that you used to enjoy prior to the claim. And in insurance, there are two types of policies. The general policies are based on are called indemnity policies. So there is no chance of profit, but there is also the investment policies, and this is the life sector. So in life, there is a chance of profit if you buy an investment related life product. But in my lines of business, which are the traditional lines of business, property, motor, they're always based on indemnity, reinstatements. So the insurance company or the insurer will put the insured in the same position that they used to enjoy prior to the claim. The policyholder is not supposed to benefit out of insurance. So this is one of the very basic fundamentals of insurance. Yes, so peril and hazard. So we use those terminologies a lot in insurance. So peril would be the proximate cause, okay? What is the cause, okay? Or what is the event that has caused the claim? It could be fire has caused the claim. It could be a flood, a heavy rain. In many other countries, luckily, we don't have significant exposure here in our region. But if you look at countries like Turkey, some countries in Latin America, Chile, Japan, earthquake is really a major peril or hazard. So hazard is a condition or a situation that really increases or creates a chance of a claim. Leaving in property, if you don't manage your electricity, if you don't take good care of the housekeeping, if you don't maintain even your firefighting appliances, okay, waste management is very important. If you don't manage your waste adequately, all of those could lead to a bigger claim should a claim occur. So they could lead to two things. They could lead to the claim itself, they could lead to a fire, or even if there is a fire, but by the existence of this situation, of this hazard, the claim potential could be much bigger. And hazard could be a moral hazard or a physical hazard. So let's start with the physical hazard. So the physical hazard would be any physical condition like the one we just explained, a physical condition that increases the likelihood of losses, like, I don't know, the existence of flammable material, okay, lack of maintenance to a car, let's say a car with poor maintenance, poor brakes, poor tires. So this would be a physical hazard that increases the probability of or the chance of a claim. The moral hazard would be, it's not a physical hazard, but it has to do with the honesty of the insured himself. So if an insured or if a potential business owner who is known to be on the brink of bankruptcy, who is known to be having financial troubles, comes and he or she, they ask for a fire insurance policy with business interruption, I will have to pay extra attention, because the probability of having a higher moral hazard, okay, is significantly higher compared to a steady business. So moral hazard, it could also be deliberate act. Okay, you go and you insure your car, you're unable to sell your car, you insure your car, you get an own damage comprehensive policy, and you go and you total your car the second day. So this moral hazard has to do with the honesty of the insured himself, and not a physical hazard or a physical situation that you could see or you could fix. But it's something which is intangible, and you will have to study as part of the underwriting aspects when you try to price or insure any subject matter of insurance. And it is equally important to assess really the moral hazard of the insured. So those are, I'm not going to dwell a lot about the characteristics of an insurable risk, but we know that an insurable risk, there has to be a law of large number. So insurance is based on pooling. Yeah, you pool a number of risks. Okay, as an insurer, you have a portfolio of, let's say, 100 houses, and it's your job as an insurer to charge adequate premium. Adequate premium meaning, you as an insurer, you don't expect all the 100 houses to get or to be hit by a fire. You expect two total losses and 3 partial losses. So this would be the cost or the amount of premium that you would need, okay, from the whole pool to compensate those who suffer losses. So insurance is always based on one main fundamental: the losses of the few are paid for by premiums of many. So we collect a lot of premiums, and then for those who suffer losses, for those few risks that suffer losses, we'd be compensating them from this pool. Also, insurance has to be, an insurable risk has to be accidental. We don't insure against wear and tear. It's not something that we insure against. We don't provide insurance against depreciation of a car. Okay? You don't buy insurance and say, okay, I'm buying an insurance cover for this vehicle because I'm afraid that the market value of this car will reduce in 2 years. Okay? So the trigger has to be accidental. The trigger has to be accidental. That leads to a claim. And one of the main features also is unforeseeable. We cannot foresee if there is a storm coming according to the weather forecast tomorrow. Okay, I would be reluctant to issue a policy today against flood and windstorm for a property risk, knowing that this, especially a classical example would be the east coast of the U.S., where you see a lot of hurricane activities. If there is a cyclonic activity close to Florida, you would be reluctant to go and issue a policy for a house before the landfall. So the claim has to be, the potential for a claim has to be unforeseeable. And it has to be measurable as well. So nuclear, for example, nuclear war cannot be insured because the potential of damage cannot be measured. It cannot be measured because of the lack of data. It's not something that we see every day. It's not something that we see every year. And the potential damage impact would be devastating. So there is no premium that you could charge to insure against such a peril. So the potential claim has to be really a measurable amount for you to be able to charge a premium. And because of the law of large number, because we are pooling risks, okay, the premium has to be affordable. If you have a house for a million Saudi riyal, you cannot really insure it for 800,000. It doesn't work this way. And that is because we go back to the fundamental of losses of the few are paid for by premiums of many. So an insurance company would pool the risks, okay, in a pool, and they're obliged to charge an adequate affordable premium to each individual policy, by which the whole pool is protected should there be a few claims to a number of policyholders. So the premium has to be affordable in relation to the sum insured or the value at risk. Yeah. So the legal principles of insurance. If I want to insure something, I must have an insurable interest. Okay. If I want to insure a car, a vehicle, I must have an insurable interest, a relationship which is recognized by law. So I must own the car for me to insure it. I cannot go and insure my friend's car under my name. So the insurance policy and the car ownership, they have to be under the same person's name, because that person has an insurable interest in the subject matter of insurance. And also an insurable interest if you think about even life policies, so who would be generally the beneficiaries? The beneficiaries of a life policy would be his immediate family. It would be his family. It cannot be his friend or a friend of a friend. You cannot go and you issue a life policy against a life of somebody else. So if he or she dies, God forbid, you get paid by the insurance company because that relationship is not recognized by law. Insurance is also based on utmost good faith, and this is a very fundamental legal principle of insurance. So you as a policyholder, when you go and you would like to insure a property, you have a legal duty of disclosing all material facts. And a material fact means any piece of information surrounding the risk that might affect the decision of the insurance company. And the decision could be writing the risk, insuring your property or your car, or it could be whether they charge you 100 Saudi riyals or 200 Saudi riyals. So you have an obligation. You see this even in many forms. So in many forms of insurance, they give you this declaration form, and they ask you questions. And this is a form of disclosing all material facts. So the policyholder has a duty to disclose all material facts to the insurance company before the insurance company makes a decision about whether to insure or not, or how much to charge in terms of premium cost. And indemnity. So indemnity would be, again, we talked about this, that you're not supposed to benefit out of insurance. Insurance is not a contract whereby you as a policyholder is supposed to benefit, because insurance is based on indemnity, with the exception would be life investment insurance products, where you as the policyholder, you outlive, let's say, the calculated mortality, and then you have a chance of making profit on your premiums or the investments that you have paid over the years. But the traditional non-life or the general or the property and casualty bit of insurance, that is always based on indemnity. And an insurance company will always put you in the same position you used to enjoy prior to the claim. You have a car accident, the damage was a fender and a bumper. The insurance company will replace both or will fix both, and they will put you in the same position you used to enjoy prior to the claim. So your property got burnt, reinsurance company will pay you the reinstatement value based on the policy. And if you have a business interruption or loss of profit coverage, then they will pay the loss of profit bit. But you're not supposed to benefit out of insurance. This is the indemnity concept. And subrogation, which is if let's say you have it's the right. So it's a right by which the insurance company, if insurance company indemnifies you for a fire claim that is caused by somebody else, they have the right to go and subrogate. They have the right to go and they sue the wrongdoer. They sue the person or the property owner that caused the loss to your property. This is the subrogation. It's the right of the insurance company to go and claim from the wrongdoer that has caused the loss. Okay, we come to a more interesting part, which is the reinsurance. So reinsurance in basic, it means insurance of an insurance company. And we said initially during the presentation that even reinsurance companies, they buy protection. So if you look at this slide right here, you see many insureds, okay, many policyholders. They go and they insure individually their risks with an insurance company, and the insurance company would buy reinsurance protection from a reinsurance company, and the reinsurance company would also buy protection from a retrocessionaire, which simply means reinsurer of the reinsurance company. So who basically offers insurance? Traditional reinsurers like ourselves, Saudi Re, Munich Re. It could be state-owned reinsurers. They also provide or offer reinsurance capacity. Could be a market like Lloyd's. They also provide reinsurance capacity, or it could be a direct insurance company. It could be another insurance company in the market that could write inward reinsurance. So inward facultative, that is a form of reinsurance as well. Or it could be an underwriting agency, or it could be even a broker with a binder or with a facility from reinsurer who's able to accept or write insurance or reinsurance on behalf of reinsurers. So what is the role of brokers? Okay, so brokers, the role of brokers is basically to negotiate reinsurance with the reinsurer instead of the insurer's behalf, and they also service the insurance companies in terms of their reinsurance needs. So what kind of protection do they need? What type of protection do they need? Handling of accounts, handling of claims, managing large claims, defending a claim, premium collection, premium payment, advice on various wordings, clauses, legal advice. So all of those are really some of the services that are provided by reinsurance brokers. So why insurance companies need reinsurance? So one is capacity. Reinsurance companies, because of even the largest reinsurance companies in the world, you name them, Allianz, AXA, everybody buys reinsurance. Okay, so reinsurance is a form, or insurance, one of the fundamentals is also spreading the risk over a wider capital base. So no matter how big you are, you also need protection. So underwriting capacity is one of the benefits of buying insurance. Protection against catastrophic losses, especially in nat cat or natural catastrophe prone areas. Companies, they need to buy reinsurance to protect themselves and their investors and their capital against catastrophe losses. Reduce volatility. Without reinsurance, your losses or your P&L, profit and loss account, would be volatile. One year you have a lot of profits, the other year you have big losses. So reinsurance is a form of, smoothing or reducing the fluctuation of your P&L account. And transfer of knowledge, because reinsurance by definition is a cross-border international business. So, and reinsurers have expertise in many areas all around the world. They're presented everywhere. They've learned about many exposures, different markets, different practices, different products, and they could provide advice to insurance companies about certain products, certain lines of business, certain ways to tackle different issues. I don't know, IFRS, solvency, other things which are really a bit more advanced in other markets. And reinsurers could also provide input and transfer of expertise and knowledge to the insurance companies. The last slide I'm going to talk about now, before I hand over to my fellow presenter, Ms. Maisa, is reinsurance. So reinsurance is there are two fundamental types: treaty, okay, and facultative. In facultative, naturally, or briefly, facultative, you would insure or evaluate each risk on its own merits, okay. And the type of insurance could be pro rata, proportional, or it could be excess of loss. We'll talk about the difference between the two. In treaty is reinsurance of a portfolio. So rather than insuring each and every individual risk, you reinsure a portfolio of similar homogeneous risks in one policy, and that is called a treaty policy. Treaty could be proportional. So, and the most common types of proportional or pro rata treaties would be the quota share and the surplus. We've got the FAC oblique, which we're going to talk about a bit later, but it's uncommon, especially in our markets, and considering the hard market conditions of reinsurance at the moment. The excess of loss, there are three main types. There is a per risk, which is a work in Excel that provides protection for each and every risk, each and every loss. And there is so one would be per risk, two would be per event, so per occurrence, or a CAT Excel, an excess of loss that provides protection against a specific event. And the last one would be a per year. A per year excess of loss would be the stop loss or an aggregate excess of loss, which provides protection per annum for an aggregated risks to for a portfolio or to a company. That's all from my side for now, and I'll hand over to Ms. Maisa to tell us a bit more about the difference between the types of reinsurance and share a few examples. Thank you very much.
Thank you, Fahd.
Maisa, the floor is yours.
Thanks. Okay. So now we'll start talking about facultative reinsurance. Facultative was the earliest form of reinsurance. So it is reinsurance of individual risks. So each risk has a separate reinsurance contract. The insurer he's not obliged to, he can offer an individual risk to the reinsurer. The reinsurer underwrites the risk and decide whether to accept it or not. And if he does, under what terms he agrees the coverage. So it is optional for both the insurance company to cede the risk and for the reinsurer to accept it. Insurance companies receive a big flow of submissions. So going to reinsurers on each account for them to underwrite and to find support is time consuming for both the insurance company and the insurers. This is why treaty is more convenient. However, there are some restrictions under the treaty, and therefore facultative reinsurance could be used in the following circumstances: where the risk is excluded in the insurer's treaty. As the treaty is an agreement, so there are conditions there and there are exclusions. Mostly, let's say, for the occupancy, if we have offshore oil risk, okay, insurance company has an offshore oil risk, which is mainly not covered under the treaty. Therefore, if they want to cover it, they should go and seek for the facultative market reinsurers. Where the risk is exceeding the maximum limit. You know, the treaty has a capacity limit, a maximum amount that each risk can have under the treaty. Okay, so if the cover can be accepted under the treaty, but has a high sum insured value, then it can be placed partially under the treaty, okay, for the treaty capacity allowed for this risk, and the remaining part, which is exceeding the treaty capacity, can be placed on facultative basis. The performance of the treaty is mainly homogeneous, so there are a large number of accounts and the portfolio is mainly consistent. So let's say there is a treaty composed of portfolio mainly, let's say, with category 1 and 2 risks. If the insurance company receives a plastic factory to cover, it is different from the others and it's more risky, okay? Therefore, even if the treaty allows the insurance company to place it or to place part of it under the treaty, the insurance company can prudently decide to place it on facultative basis because the exposure of this risk is high. So if a loss occurs, it will ruin the full treaty results. Since we're talking here about facultative, it's very important and crucial to know, to establish exactly the same coverage between the FAC reinsurance support and the original policy. So we say that it should have the cover to be on a back-to-back basis because the insurance company can be exposed to risks that are not reinsured, that are not covered by the reinsurer in case they are not the same. And on the FAC, as Fadil have said previously, there is quota share and there is excess of loss FAC. Okay, we will talk about quota share and excess of loss under the treaty. However, the same treatment and principle of calculation will be applied for treaty or for facultative. And even on facultative, we can see a quota share, which is covered by an excess of loss known as common account. So we will go now to the proportional treaties. Any treaty, a treaty by itself, or a compulsory, which is an obligatory reinsurance, it is done once yearly for the entire portfolio of the insurance company. And the insurance company has the full underwriting authority under the treaty. This is why they can submit their quotations much quicker to their clients rather than going to the FAC market. What is proportional treaty? It is where the insurer is obliged to reinsure the specific risks specified in the treaty and where the reinsurer is obliged to accept those risks. So there is an obligation from both parties, one to cede the risk and the other to accept it. So once every year, the reinsurer and the insurance company set the criteria for covering the full portfolio of the insurance company under an agreement called treaty. The proportional treaty outlines the capacity, which is the maximum liability for the risk, which varies as well depending on the categories. It sets as well the conditions, the exclusions, the event limits, the commissions, the territorial scope. So many criteria are there. This agreement shows that there is a real partnership and trust between the insurance company and the reinsurer, as the insurance company is the one who's doing the underwriting, yet the reinsurer is sharing the outcome of the treaty result for the whole portfolio of the insurance company with him. So there is, because here there is the follow of fortune principle. Okay, so proportional treaty reinsurance is written proportionally, so at the same proportion or percentage in terms of risks, premiums, and claims. So the risk when written, it is split into a retained share, which is the insurance company's share, and the ceded share, the reinsurer's share. The proportional treaties are based on the sum insured liability split. So once the underwriter accepts and writes the risk under the treaty, he will split the sum insured liability between the part on the cedent and the part on the reinsurers. And based on this split percentage, the same percentage will be applied for the premium quoted and for the claim in case it happens. We have two types of proportional treaties. There is the quota share treaty and the surplus treaty, even though the treatment is different for each type, but the principle of proportionality is there in both. So we will start with the proportional treaty. The quota share. The quota share treaty is an obligatory agreement where the ceding company has to cede a fixed percentage of all the risks, and the reinsurer is obliged to accept all the cessions made, usually subject to a maximum amount any one cession. This quota share determines how liability, premiums, and losses are distributed between the insurer and the reinsurer. So a quota share treaty is a proportional treaty, and up to the treaty limit, the ratio of retained liability to ceded liability is the same for each and every risk. The insurer cedes a fixed percentage of liabilities, premiums, and claims regardless of the sum insured up to the treaty capacity. The treaty maximum limit, the capacity, is a fixed amount agreed for the whole contract period. Now we will see some examples on the quota share treaty. Let's say we have a treaty with 50% retention and 50% cession, both together up to 100% treaty capacity being 10 millions. Here we have 5 examples. The line in red is showing us the treaty capacity. So for each and every risk which is below the 10 millions, it is going to be fully placed under the treaty with the percentage of 50-50. 50% retention, 50% cession. So here let's take the example, for example, risk 3. It is 8 millions, okay, of sum insured. So 4 millions, 50% of the 8 millions will be retained by the insurance company, and the other 4 millions will be ceded to the treaty reinsurers. It all happened, if you see all of them, risks 1, 2, 3, 4 are below the treaty capacity. Now if we look at risk 5, for this risk, the sum insured is 12 millions, so it is exceeding the treaty capacity. Then here we'll place up to 10 millions under the treaty, and for the remaining 2 millions, we're gonna go on for the FAC market to place it. So it's gonna be placed on the facultative basis. This 10 million out of 12 will be split as well, 5 millions retention, and 5 millions gonna be the reinsurer's cession. Now we will do some examples, okay? We will look at the example now, and you will be answering it, okay? So let's take the example, we have a quota share treaty where the insurance company is retaining 25% of each risk, and the reinsurer is accepting 75% quota share up to the treaty limit for the 100%. So the 25 plus the 75, the total 100% maximum limit is 5 millions. Okay? Now let's say we have a risk of 100,000. We need to check what is the insurer's share, what is the treaty reinsurer's share, and if there is a need of facultative, what is the facultative reinsurer's share. Okay, we will do the example now on the risk part, which is the 100,000. For the premium and for the claims, we will do them later on together. It's gonna be the same percentage split for risk, premiums, and claims. So once we do it for risk, it's gonna be the same percentages for the premiums and claims. Now for you to do it, you will go to the left side.
Continue without the survey.
Okay. So let's do it together then now. Okay, then the risk is 100,000. Okay, so it is less than the treaty capacity, because we said that the treaty capacity here is 5 millions, right? Then it is less than the treaty capacity, so it can be fully placed under the treaty. Since it's placed under the treaty fully, the share is always fixed, 25% retention and 75% cession. So this 100,000 is going to be split, 25,000 liability retention for the insurance company, and 75,000 will be the cession. Now, if we go to the premium and the claims, the same percentage of 25% and 75% will be there as well. Okay, so as well, 25% of the 10,000 is retained by the insurance company, and 7,500 is the reinsurer's share, and the same for the claims. Now let's take another example for the same treaty. So here in this example, the risk is 10 millions. Okay, so for 10 millions, this risk is exceeding the treaty capacity. Therefore, definitely we will need facultative support. So here, the treaty capacity is 5 million. So what we will do, we will place till the full treaty capacity, okay, 5 million, and then what is exceeding the treaty capacity, 10 million minus 5, so there is 5 million remaining, it's going to be placed with the facultative market. Okay, so 5 million under the treaty and 5 million with the facultative reinsurers. This 5 million, which is under the treaty, will be definitely split between 25% retention and 75% cession. Okay, so 25% of the 5 million is 25% of 50% of the risk, because the risk is 10 million. So 25% of 50% of the risk is 12.5% of the whole risk, and 75% the treaty reinsurer's share of the 5 million is 75% of 50% of the risk, being 37.5% from the whole risk, from the 10 million. Accordingly, the risk of 10 million is split. 12.5% will be retained, 37.5% will be the treaty reinsurer's liability, and 5 million will be the fac reinsurer's liability. Once we define this percentage of 12.5, 37.5, and 50%, the same will be applied for the premiums and for the claims. Now we will go and check the advantages of the quota share treaty. Actually, the accounting and the reporting of business is simple, because as we have seen, it is the same percentage, being in our example 25% retention and 75% cession up to the treaty capacity. And the reinsurer is participating on all the risks, right? Accordingly, they will be paying part of their share on each and every claim. So if there is an increase in the claims frequency, then the cedent will be relieved from each and every claim. The reinsurer will be participating, so they will be relieved partially from all these claims. As we have said, the reinsurers are participating on all the risks of the portfolio, so in the small, in the medium, and in the large risks. So the reinsurer here in the quota share is participating in the attractive risks in addition to the less attractive ones as well. Therefore, the reinsurer can provide good commissions under the quota share treaty, as they are having the full portfolio, okay, participating in the full portfolio. And definitely for all the treaty, the quota share and the surplus, all the proportional treaties, they will provide better commissions than the proportional facultative, because there is definitely less administration under the treaty than under FAC. Now let's see the disadvantages of the quota share treaty. Since the quota share involves the cession of all the business, so there is a large amount of income which is ceded away, especially if the treaty results are positive, so it's profitable. Secondly, the quota share treaty is inflexible, because once we have preset the percentages, we cannot change them. So we cannot vary the retention on a risk by risk, noting that usually insurance companies would like to maintain more from small risks and category 1 risks mainly, which are more profitable. And the third disadvantage is that a quota share treaty still leaves the insurer exposed to nat cat losses or individual large losses. Because let's have the example, if an insurance company is retaining 20% and ceding 80% to the reinsurers, let's say there is an event loss with 500 million. So 20% of this 500 million is 100 million, which is the insurance company's share, and which is relatively a big share for the insurance company to cater. Now we will go to the surplus treaty. A surplus treaty is an agreement whereby the ceding company is obliged to cede any risk above the retention, which is here a fixed amount, it's a gross line, that the reinsurer is obliged to accept all the surplus liability that is exceeding the insurer's share. So the capacity of a surplus treaty is always a multiple of the insurance company's retention, and it is referred to as lines. So it is a multiple of lines. A line describes then the amount of the insurance company's retention taken on an original risk. With this kind of treaty, the reinsurer does not participate on all the risks, as it is the case in the quota share. Instead, the insurer retains all the risks up to a certain amount of liability being his retention, the gross line. Okay, so under the quota share treaty, we have the same percentage of retention and cession on each risk, while under the surplus treaty, we have a fixed amount that the insured retains all the risks up to it and reinsure fully for the 100% of all the risk that is above this amount. Let's check some examples. Here in the examples, we have taken as well 5 risks. So we can see if we have a surplus treaty with a gross line 2 million. So it is the insurance company's retention up to 2 million. And there are 4 surplus lines. 4 surplus lines mean 4 multiplied by 2 million, so it is 8 millions. Okay, because each line is 2 millions. Accordingly, the treaty capacity fully between the retention of the insurance company and the cession is 2 millions plus 8 millions, it's 10 millions. So the red line is showing us the treaty capacity here. If you see here, the retention part of the insurance company is maximum 2 million, the blue one, okay? So for risks 1 and 2, the full risk is up to 2 million, so it is fully retained by the insurance company. For risks 3 and 4, it is up to the treaty capacity, however, it's higher than 2 million. So the insurance company will retain the first 2 million and then they will reinsure the remaining part. For the fifth risk, it is 13 million, so it is higher than the treaty capacity. Accordingly, 10 million will be under the treaty and the remaining part, which is the 3 million, will be placed on the facultative basis. Now let's have as well an example of a surplus treaty where the retention, the gross line, it's 1 million. We have 4 surplus lines, so 4 millions, okay? 4 multiplied by 1 million. So the total capacity of the treaty is 5 millions, which means that every risk that is up to 5 millions can be placed fully under the treaty. Now here we have an example of a risk of 100,000. So 100,000 is less than the 5 millions, so it is placed fully under the treaty, so there is no need for facultative. And this 100,000 is less than 1 million, so it's below the gross line, and accordingly it will be fully placed under the insurer's retention. And the same will be applied for the premium and for the claims. Now let's go to another example. For the same treaty, we have another risk with 3 million. So 3 million is less than 5 million, and accordingly, definitely it's going to be retained fully under the treaty. However, the 3 million is going to be split. The first 1 million will be retained by the insurance company, and the remaining 2 millions will be placed with the treaty reinsurers. Accordingly, the split is 1/3, which is 33.33% is the cedent's retention, and 2/3 is the reinsurer's share. This split, once have been decided, 33.33% retention and 66.67% cession, the same will be applied for the premiums and for the claims. Now, if we have an example under the same treaty for a risk of 10 millions, here 10 millions, it is exceeding the treaty capacity, which is 5 millions. Accordingly, 5 millions will be placed under the treaty, and the remaining part, which is 10 millions minus the 5 millions, which is 5 millions as well, will be placed on the facultative basis. So 5 millions are placed under the treaty, and the other 5 millions on the facultative basis. How the 5 millions will be placed under the treaty? The insurance company will retain 1 million, and the 4 millions will be placed with the reinsurer, with the treaty reinsurer. Accordingly, the percentages here are 10% 40 retention, 40% cession to the treaty, and 50% with the facultative reinsurers. So here, if you see that in the 3 examples that we have seen, the percentages have changed. In the first example, the cession under the treaty was nil. In the second example, it was 66.67%. And here, it is 80% under the treaty. It's 40% from the full, so 80% under the treaty. So each and every time, the percentage is different under the surplus treaty. However, what is fixed is that up to 1 million is the retention of the insurance company. Now we will go and see the advantages of the surplus treaty. The surplus treaty allows the insurer to vary its retention upon a particular risk. So there is here an automatic capacity available upon a particular class and size of risk, and accordingly, it allows the insurer to reinsure any part of the risk under the treaty above the gross line for 100% share. So the reinsurer is taking the full part 100% share above the gross line. And as a result of that, it enables the insurance company to handle larger risk, and it reduces the probability of suffering random large losses because the reinsurers will be handling this part, which may badly pressure the insurance company's financials. The insurer is allowed to retain a greater portion of its premium income because for the small risks that are below the line, the gross line, they will be fully placed by the insurance company. And the insurer receives a ceding commission, which is usually sufficient to pay the acquisition cost, together with an additional as well contribution to underwriting profit. However, the quota share commissions are usually higher. Now, what are the disadvantages of surplus treaty? As surplus treaties enable the insurer to establish and maintain more consistent retained portfolio, it contains higher exposure to large risks for the reinsurer, as we have said. And accordingly, this wide distribution of business for the reinsurer will be exposing him to loss experience to a greater variability. So the reinsurer will suffer more than the insurance company if the loss experience of high-risk group deteriorates. And accordingly, comparison of results between the insurer net result and those of the surplus reinsurers can be different. In addition to that, as the capacity in the surplus treaty is much wider than the premium ceded to it, there would be an imbalance of the portfolio ceded. This can be measured by the ratio of premium over capacity. Let's have the example. If the ratio of a premium over capacity of a treaty is 1/10, this means that if only one loss hit the full treaty capacity, the reinsurer will need 10 years to recover from this loss. And there is one other thing to add on the surplus disadvantages, is that the cedent stands or falls by its chosen retention, so it's very important to choose the correct limit line. Here in the market, it's very common to see a quota share and surplus treaties combined, where the gross line is the quota share limit. Okay, so now it's important as well to mention that under proportional treaties, quota share and surplus, the premium ceded under the treaty is the gross premium paid by the original insured to the ceded. And as the insurance company is sharing part of this gross income, while it has as well admin expenses to pay, therefore the reinsurer gives back a commission to the cedent. There are several types of commission under the treaty. There is the sliding scale commission, which provides a provisional commission calculated during the treaty period at the end of the year and in the coming quarters after that. Depending on the treaty performance, the provisional commission is adjusted to reflect the accurate commission, which increases along with a lower loss ratio, so if the portfolio is profitable, and the commission decreases along with a higher loss ratio. And there is always a minimum and a maximum commission provided with the sliding scale. There is the flat commission, which is a fixed commission regardless of the performance of the treaty. In addition to the above, and mainly with the flat commission, there can be a profit commission to give an incentive to the insurance company to underwrite profitable accounts. The profit commission is calculated after getting the profits of the treaty, being the income, the premiums, less the outcomes, which are the paid losses, outstanding losses, commissions, reinsurers management expenses, losses carried forward from previous years. So once we have this profit, and if it is a profit, then the profit commission will be a percentage of this profit. This percentage as well depends on the loss ratio. So now, after seeing the quota share.
Maisa, it's mean this is end of the agreement of the treaty.
What is when we calculate what?
This the
profit.
commission.
The profit commission?
Yes.
The profit commission we calculated at the end of the year, but you know, in the proportional treaties, you always receive quarters. So every time, every now and then, in every, let's say, quarter or every 6 months, it's going to be adjusted again and again, depending on if we receive more losses, then the loss ratio will vary. And accordingly, the profit commission as well will be adjusted. Okay. Until the treaty expires, there will be no more losses under the treaty.
Okay, thank you very much.
Okay. Now we will go to the facultative obligatory. Facultative obligatory reinsurance is a form of treaty for placing a number of individual cessions. So it combines the characteristics of both treaty and FAC methods. As with all treaties, the contract is made yearly, but the cedent may cede facultative risks, and the reinsurer must accept a share of this specified risk underwritten by the cedent. So there is here a level of anti-selection in this type of cover being optional for the insurance company, however, it's compulsory for the reinsurer. This type of treaty generates small premium relative to very high exposures. So a single claim may have a significant impact on the profitability. This is why it's not preferable or mostly accepted by several reinsurers, and definitely its level of commission is not high. Now we will go to the excess of loss treaties with Fadil. Fadil.
Thank you very much, Maisa. Okay, so thank you, Maisa. Maisa talked about proportional treaties. What is a quota share? What is a surplus? What is a PAC oblique? How do they work? What is the objective, advantage, disadvantage of each? And proportional treaties are always based on some insured, whereas non-proportional treaties are based on losses. So proportional treaty, we share everything in a pre-agreed quota, be it a surplus or a quota share or a FAC oblique facility. In non-proportional, the agreement is based on losses. So we protect the insurance company in excess of a certain point. Just like the deductible of the motor policy. So in a motor policy, in your original motor policy, what you get is you get a protection, but you pay a deductible, the excess that you pay, I don't know, 1,000 Saudi Riyal or so under your insurance policy. This is a form of excess or deductible. So while proportional treaties are based on some insured, non-proportional treaties are based on losses, and the insurance and the loss are not shared proportionately like the quota share. Okay. In non-proportional in a non-proportional treaty, usually it's the same form, whereby you have a portfolio that you wish to protect. However, you would like to protect this portfolio, okay, by way of buying. You define what is your maximum tolerable loss, okay, per risk and per event, and you buy an excess of loss portfolio protection. This enables you to retain all the premiums. In proportional, you would be giving out all the premiums. You know, in proportional, also you will follow, or reinsurers will follow the fortune of the market. You know, our markets here in the MENA region, in Saudi Arabia, in Bahrain, in the Gulf, the markets are highly dependent on proportional capacity, okay? Whereas companies, they buy a vanilla mix between quota share and surplus, and the quota share, the retention is protected by an excess of loss. So to have a balance between the premiums that they pay and the premiums that they receive. In proportional, reinsurers will follow the fortune of the market. So if the market is, if the primary pricing is very thin, you will get a share of that. If the primary pricing is adequate, you will also get a share of that. In excess of loss, no. In excess of loss, the reinsurer will price the cover itself. We'll have an example just to look at, have better clarity. So just see. Okay. So a classical excess of loss will have a layer limit, okay, and it will have a priority or a deductible. In this example, the 750,000 would be the layer limit, and the 250,000 would be the priority or deductible. So for each and every claim up to 250,000, the reinsurer will pay zero. For each and every claim where the amount exceeds 250,000, the reinsurer will start paying in excess of 250,000. So if we have a claim of 350,000, the insurance company will bear, okay, will retain will pay the first 250,000, and what is excess of that is the 100,000. This will be paid by the reinsurer of this excess loss treaty. Yes, so a priority would be the loss amount an insurance company is prepared to retain. Let's say we're pricing an excess loss treaty. The insurance company would say, okay, you know, based on the premium that we collect and the statistics that we have, we believe that for each and every claim, we need protection, let's say in excess of 500,000 Saudi riyal. Okay, so the higher the priority, the lower the premium. The lower the priority, the higher the premium. Companies would typically say, okay, we don't want to involve reinsurers, or we don't want to buy something that we do not use. So they would look at their book and they would look at the statistics and they will say, okay, in excess of this point, we usually would like to get a protection against severity, not against frequency. Because within the priority, there is a lot of frequency of claims. In excess of the priority, this is where reinsurance comes into action and they protect you against severity. So as we said, the priority would be the amount borne by the insurance company for each and every loss, and the layer limit or the limit would be the maximum amount that the reinsurer will be paying for each and every claim based on the treaty structure. So this is an example. If we take an example and we consider an insurance company writing a portfolio of homeowner property insurance houses, and the company decides that it is willing to meet or retain a claim of 250,000 Saudi riyal. So this is the maximum tolerable amount by the insurance company. They say anything within 250,000, we don't need to pay premiums to reinsurer to get protection. We could retain it ourselves. We have sufficient premium ourselves to pay for those small claims. However, if there is severity, okay, then we'd like to buy a reinsurance protection. And in this example, you'd see that the cover or the structure is 750,000 Saudi riyal in excess of 250,000. So for each and every claim, 250,000 will be borne or paid by the insurance company, whereas the reinsurer will pay up to a maximum of 750,000 Saudi riyal in excess of the 250,000. So here typically the maximum underwriting limit, okay, of houses would be 1 million. Okay, so let's look at an example and take a claim for this structure of 150,000. So if we have a claim of 150,000, the reinsured typically in this case would have to retain the whole claim. So reinsurer will pay 0. Okay. And because the amount is less than 250, the reinsurer will pay 0, and the full amount will have to be paid by the insurance company or the cedent company or the reinsurer. If we have a claim of 400,000 Saudi riyal, the priority, as we said, is 250,000. So this will be paid or borne by the reinsured, and the remaining or the excess will be paid. In this case, 150,000 will be paid by the reinsurance company or the reinsurer of this layer. If we have a claim of 1.275 million Saudi riyal, we said that the total cover is 1 million Saudi riyal. So 250,000 will be paid by the reinsurance company. 750,000, which is the maximum amount or the maximum layer or the layer limit that the company has paid for, will be paid by the reinsurer. And we have an additional 200 or the remaining or residual 275,000. This will go back to the insurance company because they have not bought adequate cover for their own portfolio. So it is the duty of the company to ensure that they buy adequate cover for their portfolio based on the maximum underwriting limits. So why do we layer? Typically in excess loss, we don't see a structure of 99 million in excess of 1 million. No. We see layering, layer 1, layer 2, layer 3, layer 4. And there are many reasons. So for simplicity, we have highlighted or mentioned the 3 most important reasons. So one would be the smaller the layer, the easier to manage and to price. If I have a layer of 99 million in excess of 1 million, the layer is so wide and the ability for me to price adequately is low. Whereas if I have a layer of say 10 or 15 million in excess of 5 or 2 million, then the layer limit is smaller compared to the priority. And this allows the reinsurer a better ability to price. Also, layering enables you to cover different classes of business under different layers. If we have layer 1, 250 in excess of 250, and layer 2, 500 in excess of 550 of 500,000, we could say, okay, for layer 1, okay, we'd like to cover casualty lines of business, so employer's liability, workman's compensation, small lines of business could be covered under layer 1 because we don't have underwriting limit. We don't write anything with a value of more than 500,000. Layer 2 could protect us against other lines of business. So layering enables you to differentiate between coverage for each layer. Each layer could be providing different coverages for different lines of business, or you could say, okay, I need a pair risk protection. The maximum tolerable amount that I could retain is 250,000 per risk. But per event, if I have an event, one, let's say, earthquake or windstorm or a major flood, then I could tolerate up to 500,000. In this case, if you have an event, layer 1 will not respond, layer 2 will respond. So layering enables reinsurers to price adequately, that's number 1, and to provide even insurance company the ability to cover different lines of business or different triggers for each layer. And 3, placement. Some reinsurers have appetite to write lower layers because the premium is high. Some reinsurers, and here the frequency is high. So the probability of a claim under layer 1 is much higher than a probability of a claim under layer 2 and under layer 3. So some reinsurers have the appetite to write more business under layer 1 and less business under top layers or higher layers where there is severity, no frequency. And other reinsurers have a different appetite. They say, okay, we don't want to be involved in lower layers. Lower layers, they involve frequency. We get a lot of small claims and we pay premium. We'd like to be involved in higher or top layers. So we'd like to provide coverage against severity, not against frequency. So if we go back to this example, the priority of the second layer is always the sum of the first layer. So here the priority is 500,000, and this would be the sum of 250,000 priority and 250,000 layer limit of layer 1. And consequently, if we look at layer 3, the priority is 1 million, and this would be the sum of layer limit of layer 2 and the priority of layer 2. This graph only shows you what we just discussed. If we have 3 layers, 50x is 50,000, 50x is 100, and 50x is 150. So you'd see here that by layering, the loss activity hitting different layers are different. So if you are a reinsurer of this layer, you would be participating only in this claim. Okay. If you are a reinsurer of the first layer, then you would be participating in, you would have more frequency. There are 4 claims hitting the first layer exceeding the priority. And if you are a reinsurer who is writing a unified share across all layers, then you would be benefiting from a homogeneous balance between frequency and severity. Again, for frequency, the premium paid or the cost of that layer is typically higher than top layers because of the probability of a claim hitting the top layer. So in non-proportional, there are typical terminologies that we use, and most of us have heard about the rate online. So the rate online is nothing but the percentage or the relationship between the reinsurance premium, okay, by the layer limit. Let's have an example to simplify the rate online. So if we have a cover of 500 in excess of 500,000 and the adjustable rate, okay, see, the premium is always calculated by premium base, which is the API, the subject premium, multiplied by premium rate, which is the adjustable rate. In this case, the premium base or this API or the subject premium, they are used in an exchangeable manner, would be the 10 million. The premium rate or the adjustable rate would be the 1%, and the Excel premium would be the 10 million by 1%. And in this example, it would be 100,000. So the rate online for this layer would be 100,000, this 100,000, divided by the layer limit. Well, how much is the layer limit? It is 500,000. So in reinsurance terms, we'd say that the rate, this layer pays a rate online of 20%. And what does it mean? It means, or it indicates something called the payback period. So typically, if the rate online is higher, so we're getting large premium income for a relatively smaller layer limit, the more adequately priced the layer is. So if we have a layer with the rate on line of 50%, this would typically be better priced than a layer with a rate on line of 10%. Everything else being equal, assuming the exposure is the same and the protected portfolio is the same. So the reverse of the rate on line would be the payback period expressed in years. And the payback period means how many years if we are to get the same premium and we have a complete total loss. So if we have a claim of $1 million, which is the 500,000 priority in this example, and the full limit of the layer, how many years, if we continue to price 100,000, how many years for us do we need to recover what we paid, assuming that there are no losses? So the rate online gives you a good indication of pricing. It gives you a good indication of how adequately the layer is priced. Typically, if we have a program of 3 layers, the bottom layer or layer 1 would have a bigger rate on line, and as you go up, the rate on line would decrease because the probability of a claim or loss activity hitting top layers or upper layers is significantly lower than bottom or working layers. In this example, a rate on line of 20% would mean a payback period of 1 by 20%, which means 5 years. So we need 5 years to recover a 500,000 total loss to the layer. So in another important terminology that we use is the reinstatement. So in non-proportional treaties, we'd see a reinstatement. They could be paid reinstatement or they could be unpaid reinstatement. Both are priced for. Okay, so a paid reinstatement would be this example. If we have an example of 500,000 in excess of 500,000, again a adjustable rate of 1%. The Excel premium would be the subject premium or the EPI of 10 million multiplied by 1%. This would be the Excel premium. The reinstatement is 1 at 100%, which means that this program, okay, provides 2 covers: the original cover, okay, of 500 in excess of 500, and an additional cover. If you burn this full 500, you have an additional cover of another cover. So you've got 2 covers. However, for the second cover, you will have to pay. So if you're paying 100,000 for 500 in excess of 500,000, and you have a claim of $1 million, which is 500,000 retained by the reinsured and 500,000 paid by the reinsurer, the reinsured will have to pay an additional 100,000 to reinstate the cover. So in this case, if we have a claim to the layer of 200,000, okay, which is a partial, which means we have a claim from ground up or 100% of 700,000, 500,000 is borne by the reinsured, 200,000 is paid for by the reinsurer of the layer. The reinstatement would be the claim to the layer divided by the layer limit. So typically multiplied by the Excel premium. So if we say 500 for 500,000, you need to pay us 100,000. For 200,000, how much do you need to pay to reinstate the cover? And in this case, it would be 400,000 shown in this formula. In this example, the reinstatement is always pro rata to amount only. It could be pro rata to time, where we need to factor also the time to expiry in the year. But for simplicity, and the most common feature of reinstatement in our region is reinstatement pro rata as to time, and it's shown in this example. So what is the fundamental difference? We talked about a per risk and a per event or per occurrence, or it's called a CAT Excel. So a per risk, the reinsurer will pay for each and every individual loss. for each and every car accident, the cover will apply. Is the claim above 250,000 or above 500,000 if the priority, or no? If it's below, then the reinsurer pays zero. Everything is paid by the reinsured, by the insurance company. If the claim exceeds 500,000, then the reinsurer starts paying up to the layer limit. If we have a per event or a CAT protection, CAT XL, as the name indicates, it protects the insurance company against natural catastrophe events. And in natural catastrophe events, you would have an event affecting mass number or a wide number of risks. Let's say you have a flood which has affected 20 cars. Okay, the priority will not apply once for each and every car. No, it's going to apply once for the total aggregated losses, and we'll see the next example what exactly is the difference. So if we have the same cover, okay, same cover, 500,000 in excess of 500,000, this is a per risk cover, and a 500,000 in excess of 500,000, this is the CAT XL, this is a per event cover, and we've got three claims, 600,000, 700,000, and 550,000. The per risk cover, the priority 500,000 applies per claim. So if we look at those claims, who pays for what? If we've got this claim, claim A, the claim amount is 600,000, and we're talking about the per risk cover. We said the priority or the 500,000 will apply once individually for each and every claim. The reinsurer will pay 100,000, which is 600,000 minus the 500,000 priority. If we've got a claim amount of 700,000, then again the insurance company will pay the first 500,000, and the reinsurer will pay the 200,000 in excess of the 500,000. Claim C of 550,000, 500,000 will be paid by the insurance company, and 50,000 will be paid by the reinsurer of the layer. Until now, we're talking about the per risk. If we have a per event or a CAT XL, the fundamental difference is that the priority will apply once. So if we've got the same claims resulting from the same event, okay, then the calculation would be you sum or you aggregate all the losses, 600,000 plus 700,000 plus the 550,000. They're all resulting from the same event, and you apply the priority once because this is a CAT XL, okay? And the remaining would be 1.35 million. 1.35 million, out of which 500,000 will be paid by the CAT layer reinsurer, and the remaining will fall on the insurance company if they do not have adequate protection. If they've got adequate protection, a second layer, a second CAT XL, let's say of 1 million, here 1 million in excess of 1 million, then the remaining 350,000 will be paid by the second layer. So this is the fundamental difference of per risk. Per risk, the priority applies for each and every risk. Per event, you aggregate all the claims, and then the priority will apply once. Stop loss. Stop loss is not very familiar in our region. It is familiar for something called balance sheet protection. Some companies buy a balance sheet protection to smoothen their results. In different markets, for agriculture and crop insurance, like the Indian market, some companies buy stop loss rather than traditional proportional or non-proportional. And in stop loss, as we said earlier, it is a limit per year. Okay, it's neither a per risk nor per event. It is a proportional treaty, and it operates on annual basis. The loss retention, instead of a fixed amount, would be a fixed percentage of the annual premium. So the insurance company will say, okay, we could tolerate a maximum loss ratio of 90%, but if the loss ratio increases beyond 90%, then we need to buy protection. So the reinsurer will pay when the loss trigger or when the loss ratio exceeds a pre-agreed amount or a threshold up to an agreed percentage. We'll look in a bit at an example. The cover could also be restricting by fixing a monetary amount. So the stop loss could be a stop loss expressed in percentage, 30% in excess of 90%, or it could be an aggregate stop loss in monetary amount. So it could be 20 million in excess of $5 million. Could be an aggregate amount. It could be bought for each line of business. We see that, okay, this is popular for livestock, for hail insurance, for crop agriculture, or it could be bought for, it's a multi-line balance sheet protection. A company would say, okay, we'd like to maintain a combined ratio at about 95%. So we could tolerate an additional 3 percentage points to smoothen the results. We'd like to buy an excess of loss. So in good years, our combined ratio would be a bit higher because we're paying for the protection, and in bad years, our combined ratio would be a bit lower, and this would smooth the volatility of results and enable the company to better budget and better provide investors with dividends. Simple example, if we have a cover of 40% in excess of 80% and we've got a premium of 100,000 Saudi Riyal, we have an incurred loss. Incurred is paid plus outstanding loss, and incurred loss of 110, hence the loss ratio of 110%. The company has a protection or a tolerable amount of 80% loss ratio. As such, in this example, 30% of the loss ratio would be paid by the stop loss reinsurer, i.e. this would be 30,000 looking at the numbers of this example. Another example, so if we have a company X or a company Y which has a stop loss arrangement triggering or starting at 120% loss ratio up to 170% loss ratio, and they have a total written premium of 20 million Saudi Riyal, while the claims for the same year are 30 million. What would be the amount paid by the stop loss reinsurer? So again, we have to calculate the loss ratio. The loss ratio is claims by premiums, incurred claims by premiums, multiplied by 100%. And in this example, the claims are 30 million, premiums for the year are 20 million. The loss ratio would be 150%. And the insurance company has a cover or an attachment point that starts at 120%. And a protection up to 170% loss ratio. The reinsurer would pay the difference between 150% and the 120% attachment point in monetary amounts. This would be 6 million Saudi Riyal. Again, this is not very common in our region. We don't see it much, but we're seeing now that some companies are buying a multi-line, meaning they protect their whole balance sheet, they protect their whole book. So it would cover all, let's say, lines of business or non-life or general lines of business in one program. And the objective is to smoothen results. The objective is to show steady and low volatility. And this could perhaps even help with the rating agency rating exercise as well. Again, the aggregate excess loss, as we said, stop loss could be expressed in percentage or it could be expressed in amount, but fundamentally it serves the same purpose. It's a limit per year. An aggregate per amount, if we look at the example, An aggregate excess loss would be, in this example, 500,000 in excess of 200,000. So we look at all individual claims the protected portfolio suffered during the year would be aggregated. So we aggregate all the claims, okay? And then all the claims, once the claims, the aggregation or the sum of all claims for all the protected lines of business, property, motor, whatever we have agreed with your reinsurer, exceeds 200,000, the reinsurer will start paying up to 500,000 Saudi riyal. So we go back to proportional treaties, and for a proportional reinsurer, what is the general information a reinsurer would like to see in an information or a renewal pack? Okay, so those would be the basic information that a reinsurer would like to see, and one would be the statistics. So for your proportional bouquet, you would need to provide statistics for each line of business. If you have a quota share and a surplus, then you would need to provide a split statistics for the quota share, similar stats for the surplus, and a combined stats for the line of business, quota share and surplus combined. Stats, premiums, claims paid and outstanding, taxes if any, and results, loss ratio. For long tail lines of business, so we've got short tail, which is property, typically annual policies, and we've got long tail lines of business, which are engineering, construction, CAR and EAR. In engineering, you've got annually renewable business like electronic equipment and the like, which are annual policies, and you've got long-term policies, which are the CAR or the construction policies, CAR and EAR. So for long-tail policies, reinsurers would like to see also triangulation that shows the premiums and the results, premiums, claims in 2010. How does the underwriting year 2010 look in 2011? How does the underwriting year 2010 look in 2015? To look at the development of the underwriting year and of the results. We'd like also to have a list of individual large losses. So a large loss would, as a rule of thumb, it is any loss exceeding 5% of the total capacity. Many companies here provide or define large losses as any loss that exceeds, say, the cash call or the cash loss limit, which is, in a proportional treaty. All the premiums, claims are reported to reinsurer in a quarterly statement of account, okay? With the exception of major claims. So cash calls specified in the treaty limit, any amount reaches the cash call, you as an insurance company, you have to call, or you have the right to call for immediate funds from the reinsurer in case of bigger claims, especially to assist companies with the issue of cash flow. So we'd like to see list of individual large claims, and this would give us an indication about the portfolio. Where are the losses coming from? If we're talking property, we'd like to see where are the losses coming from. Are they coming from direct business? Are they coming from inward business? Are they coming from warehouses? Are they coming from petrochemicals? Is there any specific occupancy that is causing the problems? Or is it an issue with the pricing? Is it an issue? We'd like to see the loss behavior. So by looking at the claims, we draw patterns, and the problem could be, for example, warehouses. So if you exclude warehouses, the portfolio is very profitable, and warehouses are specifically is the occupancy causing problems. So list of individual large claims to reinsurers say a lot about the portfolio. We'd like also to have a list of cat losses. So if there are losses caused by floods, by heavy rain, we'd like to see this claims or those claims separately from the individual losses. So losses are typically, we'll talk a bit about losses, but we've got attritional losses, which are losses that occur each and every year. We've got single large losses, which are losses caused by fire, a large fire to a petrochemical plant, or a large fire to a high-rise building, or a large fire to a hospital. Those are also called the man-made losses. And we've got cat events, so losses which are caused by earthquake, by flood, by windstorm, and the other act of God perils. We'd like to have a risk profile. Risk profile, in treaty, we underwrite the whole portfolio. We don't get the chance to see each and every policy. But the risk profile represents the portfolio. So a reinsurer, by looking at the risk profile, they could tell a lot about the distribution of the portfolio. How does the portfolio look? What risks in terms of size are performing better than others? What risks are priced better than others? Is it small houses that are causing the problems? Are larger risks more profitable than smaller ones? Are medium-sized risks profitable? All of this is seen in the risk profile. The risk profile is an excellent representation of the whole portfolio. We'd like to have nat cat aggregates. So an insurance company must maintain an adequate accumulation exposure management. So they need to know how much of their risks are located where. So this is important for the insurance company to define how much cat protection they need to buy. If they have a lot of aggregation, let's say in Riyadh, then they need to buy accordingly. If their aggregation of their risks are spread all over the kingdom, Eastern Province, in Jeddah, and in Riyadh, then they would need to look at the highest exposed zone or city and buy a cat protection based on that. They need to know basically their portfolio. How is it split? Where is it split across the kingdom or across the country? This is also important for rating agencies. They would like to show or to see an excellent portfolio management. Details of the underwriting portfolio. So if we're looking at, or if we're talking about property, then we need to know how much is residential, how much is commercial, and how much is industrial. And the reason is different occupancies, they behave differently. So in industrial, for example, it's you see a lot of severity, you don't see frequency. In residential, there might be frequency, but no severity. So you get more claims here, but the claims are generally small. Here you don't get many claims, but the claims are, if they occur, they are generally sizable claims. And we've seen many examples across the region. I don't need to mention names, but you know that major losses, they amount or they contribute to a larger amount. Typically, I would say typically, if we look at the property premium of a market, it should sustain two major total losses occurred in that market. So if we have a total market premium of, let's say, property premium of $2 billion, then if you have two major claims wipe out total loss, the total or the sum of those claims should be less than the total market premium. Otherwise, it's an indication generally that the primary pricing for property is a bit on the thin side. And we'd like to have details on the risk appetite or underwriting policy and underwriting guidelines of the company. Generally, we'd like to look at guidelines of different companies in different markets. Luckily, in Saudi Arabia, those guidelines are generally defined because of the regulator, which helps a lot and makes our job as a reinsurer we have more confidence in the Saudi market because we know that the regulation is strict, the regulation is clear, and the regulation is there and it is implemented. Whereas in many other markets across the region, especially in emerging markets, we would need to study the individual guidelines of each and every company separately and look at and assess their risk appetite. How do they price each and every occupancy? What deductibles do they apply? Pricing of natural perils, fire loads, and the like. So in proportional treaty, generally different reinsurers, they use different pricing tools to price a proportional treaty, but the simple logic remains the same. Whether it's Hanover, Swiss, SCOR, anybody else, the logic is the same. So in a proportional treaty, you will always have something that we call a basic loss margin or attritional losses that will occur each and every year. You will also have to price for single large losses or man-made losses. Any portfolio will have major losses, okay? So you would need to load for losses that will occur or will hit this portfolio, okay? If you look at the portfolio and you say, okay, you know, for this property portfolio, there is a major claim to the treaty once every 10 or once every 15 years. So you would need to price for that as well. You would also need to price for cat losses. So pricing for cat losses, yes, we've seen climate change and we've seen a study that was done by the World Bank, and it shows that the number of natural catastrophes or natural events have increased or have doubled worldwide since the 80s, but in the MENA region, it has tripled. So climate change is really a reality, and it's something that we are experiencing. It's something that we have seen since the Gono cyclone in Oman in 2007. We've seen a number of floods across the region: Bahrain, Saudi Arabia, Kuwait, Oman. We've seen many floods, heavy rain. So the climate is changing, and this is something that we all have to consider jointly. So yes, cat losses is something that reinsurers must price for. Tax, yeah, you would need to factor your tax, the brokerage, if there is a broker involved, and the margin required. So if you have a treaty and you've got loss ratio of 30% to the treaty, that doesn't mean you could ask for a 60% commission, because you are factoring only the attritional losses. All other factors, okay, the single large losses that will occur every number of years, the cat losses that could occur even once every 20 or once every 30 years, reinsurers must price or account for those claims or for those losses. We need to ensure that we have sufficient premium. So when there is a claim, a cat claim, we'll be the first to honor our obligations. Tax, brokerage, and margin requirements. So margin requirements would include also reinsurers like many of us. We don't want to make a lot of money, but we'd like to make some money to cover our expenses and to cover something called the cost of capital. And you will hear this cost of capital a lot used by many reinsurers, and the cost of capital is simply investors. They've put a capital with Hanover Re or with others, and they would like to have a return. And the return is what we promise our shareholders. So we take that return and we split it per line of business based on the volatility. Generally, lines of business like energy, like high-risk industrial property, would require a lot of capital because they are very volatile. And other lines of business, let's say like motor proportional, would require smaller amount of capital because they are less volatile. So a 10% margin in, say, in energy is not enough, whereas a 4% margin in certain motor proportional treaties could be enough. This is due to the cost of capital and the volatility of each line of business. This is nothing but an illustration of what we just said. Different claims, we differentiate between attritional losses, single large losses, and cat losses. Attritional losses, they occur every year, and those we price separately. Single large losses and cat losses, they occur once every number of years. So there is a retain period, which is the period that a certain portfolio will experience a single large claim or a cat claim. So what other general information that a reinsurer would typically need to price for reinsurance consideration or pricing consideration? We need information about inflation. So inflation is very important. The cost of a claim today is very different from a cost of the claim in 3 or 4 years' time. Luckily here, we don't suffer from, in our region and in Saudi Arabia, in the kingdom, we don't see a lot of fluctuation in the inflation. But if you see other countries, Turkey, for example, Pakistan, for example, where there is volatility in inflation, which could reach up to 20-25%, and also fluctuation in the currency itself. So the currency depreciates a lot. Luckily here, that is not a major factor, but typically, generally, we'd like to have information about the inflation in a country. We'd like to know also about the legal requirements. So what is the blood money or the dia? Is it a set amount? Is it the same for males and females? How does it work? It differs from a country to another. Is there a premium deposit requirements? Do we need to maintain a certain amount of the reinsurance premium with the insurance company? So all of those are information that we would need to know before we engage in any treaty or reinsurance arrangement. We need to know also about the reserving methodology of the company. Are they reserving adequately? Are they reserving prudently? And this we'd know also by looking at the triangulation. If we see fluctuation, they reserved a claim for $1 million, and then after 2 years, the claim ended up to be 10 million. So their reserving methodology is weak. And also we'd like to look at general market information. So what are the trends in the market? Is the pricing steady? Is the competition very stiff? Is there growth in the market? Is there potential for growth in the market? What are the civil defense capabilities? Do they have state-of-the-art technologies? All of those are general information that we take into account when we engage or before we engage in a reinsurance agreement. So other specific information that we also need when we price an excess loss treaty, in addition to the renewal pack, we need to know the underwriting limit for the protected lines of business. So if you have an excess loss, we need to know what is the maximum underwriting limit for motor own damage, what is the maximum underwriting limit for employer's liability, workman's compensation, if it's uncapped, if it's not limited by law, and other lines of business. We need to know generally what is the territorial scope of the treaty or of the agreement. Is it Gulf? Is it Saudi Arabia? Typically, if a country or if a company is operating in a certain country, then we'd allow the territorial scope to typically be in that respective country. because it is their respective market. It is the market that they understand. And if we would like to write business from other jurisdiction or other territorial countries, we'd go ourselves and underwrite business of those respective countries. And the other thing is that, you know, all the information and general information and the legal system, market trends, loss behavior, they differ from a country. Or even within the Gulf, you've got certain level of homogeneity between the GCC countries, but the exposure is still different. So what is the treaty structure? Typically, what is the priority, the limit? What is the number of reinstatements? Are there paid reinstatements? Are there typically in motor and casualty, we'd see an annual aggregate limit, which is a free reinstatement, which is something which reinsurers do price for, but for any treaty that we're pricing, we need to look at the requirement. Is it reinstatement or an annual aggregate limit? We need to have individual losses from ground up. Okay, and individual losses, you know, reinsurers would say from ground up 100%. It means nothing but all the losses that you have on your books, as advised by the insurer, 100% before applying anything. We need to look at those, and typically we would ask for losses exceeding 70% of the priority. So if we have a priority or a deductible of 100,000, so we need to look at losses of 75,000 and above, and that is because of indexation. So we need to look at older losses and apply indexation or inflation. For all the older losses, we bring the losses to today's value. So a loss that occurred in 2005 and costed $1 million, if the same loss occurs today, how much would it cost? As simple as that. We need risk profiles, and we need premium or premium information, or what we call EPI information. So when it comes to pricing, I think the most common method is the bearing cost. And it's commonly used for many classes of business, and it is also called the experience rating method. And I would say it is also the most reliable method if you have adequate loss information and adequate portfolio information. So the assumption is that history will repeat itself. There are certain requirements, but the loss behavior will continue to be the same for this portfolio. And what are the requirements? So we must have sufficient loss experience. So without loss experience, the experience method or the experience rating method cannot be used. And the condition that we need to have is that the protected portfolio has to be relatively stable. It's difficult if you price a portfolio of 10 million, and when we price, so all the methods that we use for the excess loss, we're trying to arrive or get closer to the what we call the magic number. The magic number is the expected loss of that portfolio, regardless of the line of business. So all those methods, we're trying to get closer or calculate or estimate the expected loss for the forthcoming period, because we always use the past to price for the future. So the portfolio has to be relatively stable in size and in underwriting practice. If we're pricing a portfolio of let's say of houses, then it's difficult to price the same portfolio for if the portfolio change and we start having a lot of warehouses and high risk industrial exposures in that portfolio. It would still give you a price, but the price will not be accurate and the price will not reflect the exposure. So your estimation or calculation of the estimated loss might not be accurate. And the bearing cost in terms of equation, it's very simple. It's the excess losses or losses to the layer divided by the premium or GMPI multiplied by 100%. Let's have an example. If we've got this example where we have a layer limit of 300,000, the priority of 200,000, and we've got different loss information for a number of years, and those are the Excel claims. So those are the claims to the layer for each and every year, and this is the premium information for different years. So calculating the burning cost, let's say for the year 2014 will be, as we said, the Excel claims or losses to the layer, 240,000 in this example, divided by 6 million, and this would give us 0.67%. So if we'd like, subsequently, we do the same for all the years. If we'd like to do or calculate the burning cost for the whole portfolio or for a range of years, then we look at the sums right here and we divide the excess losses by the premium income for all the years. In this example, what we calculate generally 2.405 by 50 million being the sum of premiums for all the years, and this would be the burning cost for all the years 2014 to 2019. This would be what we call the pure burning cost. And the pure burning cost is nothing but the pure risk exposure before allowing or factoring any allowance for fluctuation, for margin for error, any change in portfolio, or reinsurers' profits or expenses. So generally, what we quote is something that we call the commercial rate or the technical rate, which is the pure risk premium or pure risk rate, in addition to capital requirements and margin requirements of the reinsurer. The second method, I'll just glance through quickly. We might be running a bit late, and I would like to allow some time for questions. So the second method is the exposure rating, and it's based on exposure rather than loss experience. So if we don't have loss experience, then reinsurers have got pricing tools based on mathematical models that allow you to price a treaty based on the exposure of a given layer rather than the loss experience, and that is generally taken from the risk profile. So the information that we would need is generally the risk profile, API information, the loss ratio of that protected book, and assumptions on the portfolio information. So in exposure rating, there are many curves, and each curve represents a certain quality of the risk. So a cheaper curve will represent a low hazard portfolio of generally residential buildings. This would be a relatively low hazard portfolio, and a more expensive curve would be or a portfolio that has large exposure of peak risks or large risks. And large risks, just as a rule of thumb. So if you cannot a risk that you cannot see 10% of that risk to your treaty, it's too big for your treaty. So that would be a large risk. Okay. So if we look at high hazard industrial, petrochemicals, energy, and the like, those would be a more expensive, or those would have a more expensive curve in the exposure rating. The last method. So before we go, the exposure rating is not perfect. It has weaknesses, and one of the main weaknesses is that if you look at the mathematical model and the pricing tool, which unfortunately I could not put here. If you look at the pricing tool and you choose a certain curve for a given structure, so the assumption is, or what the tool is trying to calculate is, for this given portfolio and this given structure, limit, priority, and EPI, how much of the existing premium to provide this protection has to go to the reinsurer and how much has to be retained by the insurance company. So if the primary pricing is very thin, then reinsurers will get part of that as well. So in exposure rating, you follow the fortune also of the market. The last method, which is called the Pareto pricing. The Pareto pricing, if somebody is interested, I could share possibly the mathematics, the basic mathematics behind the Pareto pricing. And the Pareto pricing is based on a scientist called Vilfredo Pareto, and he came up with this distribution model. It's another method of rating non-proportional treaties, and it's used usually for upper layers, for cat cells and upper layers, or layers where you don't have sufficient loss experience. So in burning cost, you would need, if you're pricing if you have data for 5 years and you've got one claim only hitting the layer, the burning cost will not be the most appropriate or fitting tool to price that portfolio. You would need the number of similar losses of similar size to be able to arrive at the expected loss for the forthcoming period. So the Pareto is a mathematical model. It is used by which you fit a certain curve, and I'll show you how does it look like. You fit a certain curve on the distribution. It is based on loss frequency and loss severity. So how many of those losses or large claims will have in a different period of time. So a reference point and large claims, one single large claim, which is the threshold or the reference point, and a calculated retain period. So if you have a claim to this layer of $20 million, okay, and you have a retain period, you would get $20 million every 30 years. This tool would give you a price indication, this is how it looks. It might not be as adequate as the burning cost, but it is a useful tool to price layers or reinsurance treaties with insufficient loss information. So this is how the tool would look like, but the fundamentals, as we explained, it is based on a mathematical model, a retain period of certain losses. You fit a curve, and then the tool would give you a price based on the probability. So this would be the last non-proportional pricing model. I think we've covered pretty much, we've touched base on proportional treaties, basic differences between proportional treaties, quota share, surplus, fac oblique, non-proportional, per risk, per event, cat claims, and per year, stop loss treaties. What information do we need? Basic features. What are the assumptions between various treaties? And then how do we price, or the simple logic behind pricing proportional treaties? What information do insurers look at? What do we need to price any proportional treaty? And what are the basic fundamentals of non-proportional excess of loss treaties? How do we price them? And the basic or the three main pricing or quotation tools. I hope I haven't taken a lot of time. I think we're running okay with time, if I'm not mistaken, Eli. And I hope that this session was beneficial and enjoyable. I tried to keep it as simple and as considering the time and Ramadan as enjoyable as possible. So thank you very much. If you have questions, I'm open. I'm happy to answer any question. If you need specific information about a certain topic, I've put my email, contact details, so you're free to drop me a small email, and I'm happy to share more details with you. Otherwise, I think the floor, Maysa and I are open for questions. Thank you very much.
Thank you, Fadel. Thank you, Maisa. Definitely now, as Fadel mentioned, the floor is open for questions.
Yes, hi Fadel, this is Muhammad Adib from Salama.
Yes, sir.
Thank you very much for the really nice presentation right from the beginning and till end also. It's really very smooth, easy, and you can say that it's very difficult to put in, in the slides, which you have succeeded, alhamdulillah. My question is actually just a small one, that how you are thinking because of this COVID-19, what will be the change you can foresee now from here to the new era? I would say this will be a new era from now onwards.
Yes.
The things will be very changed. The digitalization will be very frequently. I mean, things like that, how you see at a price level on reinsurance contracts and the capacities from the markets which reinsurers are ready or willing to provide. This is just have a feedback on that, please. Thank you.
Thank you very much. That's not only a very good question, that's the talk of the town now, okay? So the COVID-19, yes, this is not something that many of us have forecasted or expected. Naturally now, in terms of, this is gonna change the whole, how can I say, the rules of engagement. So now, as Hanover Re in Bahrain, we've been working from home for the past month and a half. And what I could share with you from my experience is, platforms like MS Teams and Zoom and WebEx is the new norm. Okay, so this is the norm now. This is how we communicate with our partners. This is how we communicate with our colleagues, and we're even questioning the need to have a physical office. Do we really need to have a physical office, and we pay such huge expenses? So coming back to your point, absolutely, we've seen that companies also, many companies across the region, companies who are well equipped on the digital front will be less affected by the COVID-19. Companies who are less equipped when it comes to digitalization and using the Internet of Things and digitalization as a distribution and sales channel, those companies will be affected more, and they could potentially lose market share to the stronger ones, especially on the retail. I think if we think about larger risks, they will continue to buy. They will continue to buy insurance. Large commercial, large industrial, they will continue to buy insurance. Retail, I think, especially now, again, we need to think about what is happening in the primary market. It is all interconnected. Retail businesses will be affected a lot, and this will naturally affect their insurance buying. So what we expect is there will be a slowdown in the economy. I think, luckily or inshallah, once the COVID-19 or the coronavirus crisis ends, only then we'd be able to see the true effect of the coronavirus on the businesses here across the region, and this will have a tremendous effect really on the economy and on the insurance sector. But yeah, I hear you. Luckily, within the Gulf, governments here have set stimulus packages to aid the economies and to counter effect the issue or the crisis of the coronavirus. But many countries, you'd see unemployment rates are jumping through the roof. People are losing their jobs. Businesses are shutting down, and this will definitely have an impact on the business and on the insurance. Are we going to see an economical crisis? Possibly. How long will it take? How long will it last? It depends. It depends. There are various scenarios, but this will definitely leave a big dent on the business and on the worldwide economy.
Hello.
Hello.
Hello, this is Nasser Al-Mutayri. Thank you, Fadl. I'm ex-Saudi Aramco and General Electrical. Currently, I'm working as a risk engineer and loss control at Allianz Saudi Fransi. First of all, I would like to thank you guys for the invitation and for the informative presentation. Actually, my questions will be concentrated on the loss control and risk engineering sides in terms of reinsurance. I have 3 questions. Do you want me to ask it in a row or one by one?
You can ask them in a row, or
Okay.
in a row, and then we'll answer them one by one.
Okay. Well, as most of you know, majority of the buildings in Saudi Arabia have ACP cladding,
Yes.
aluminum compostable panels. And frankly speaking, I see a conservative approach from reinsurance companies when it comes to ACP. Thus,
Yes.
if we take the internal factors under consideration, for instance, the compostable materials and fire retardant materials, the question is, what is your point of view as a reinsurance companies regarding the ACP? This is the first question. The second question is, as per SAMI regulations in Saudi Arabia, we must conduct a survey report prior issuing the policy. Accordingly, we have to conduct a survey report on engineering projects before the project begins. Technically, we are conducting a site visit on an empty location. So the question is, I'm eager to know what sort of information are you guys seeking for as a reinsurance companies when you read the survey report? The third question, according to the General Authority of Statistics Report 1st, 2019, in Saudi Arabia, the top main activity in revenue is wholesales and retail trades, which has 62.7% of the whole market in Saudi Arabia. So I did a feasibility studies based on quantitative and qualitative data on selective warehouses, around above 200 warehouses in Saudi Arabia. I was really shocked when the results showed up the estimated profits versus the claims. Moreover, per civil defense regulations in Saudi Arabia, 90% of the warehouses have the basic fire protection system, such as fire pumps, sprinklers, smoke detectors, and fire extinguishers. I know for a fact, most of the reinsurance and insurance companies, when they hear the warehouses, they become a deaf because it's unreferable risks to them. So the question is there any intention to reinsurance companies to expand their interests on the standalone warehouses in the future? Thank you, Fadl, and thank you all.
Thank you very much. I'll start with the issue of cladding, ACP cladding, combustible sandwich panels, and it's across the region. See, the issue that we have seen now, again, with tighter regulation, the construction codes are being reviewed, the construction codes are being upgraded, and they're being amended to cope with the current exposure. But the cladding is an issue to reinsurers, and we've seen from many claims, especially in the UAE, how would the cladding behave? So a building that looks, or a building that we call a state-of-the-art building, once it catches fire, then it behaves like a cardboard risk or a paper risk. So the cladding is really an issue, especially for high-rise. Now, we look at the both. So what we've done is we have circulated, if I'm not mistaken, in October 2015, an underwriting guideline for underwriting of high-rise buildings with cladding. And the issue with the cladding is, yes, they increase the fire load. A class 1 risk is no longer a class 1 risk because of the cladding. And you add to it the issue of high-rise. So high-rise buildings, they are unique in their features, and they require certain civil defense capabilities to be able to fight fire, being access to the building, being the reach of the fire brigade. So those we'll have to underwrite carefully. And you said we're cautious, or some reinsurers are being cautious, and they have certain appetite towards high-rise and ACP. I agree, because they are unique in their features and they need special underwriting and special consideration. However, we cannot say that we will not write buildings with ACP. We cannot say that we will not write buildings, high-rise buildings, but we would like those to be priced and underwritten adequately. And
sorry for interrupting, Fadl. What is the acceptable percentage to you guys of cladding? Like 20% of the whole building is a cladding, 30%. What is the acceptable standard to you guys?
See, it differs. I wouldn't say that there is a the lower the better, okay? But it differs from a building to another. So in certain buildings, yes, they are cladded, but they are segregated or separated by concrete or block floors where the fire cannot really spread. So it depends on the prototype or on the building itself. But naturally, the lower the percentage of the ACP cladding, the better it is. The issue that we have in many countries, and especially in the UAE. In the UAE, for example, in the Emirates, there are about 1,200 high-rise buildings, and they all have cladding. And all of those were installed during the construction boom from 2003 up to 2008. They're cheap in price. They are very quick to be installed, and they look very nice. And nobody has really, or the construction code in many countries was not up to date. So nobody knows in many cases what is the material. But the fact of the matter, we'll have to. We cannot exclude them altogether, but we'll have to underwrite them separately. I've got some material that we have shared when it comes to ACP, underwriting guidelines, special underwriting aspects that I could possibly send to you if you maybe drop me an email. I'll move to the wholesale and trade. You are absolutely right. So the general understanding is that warehouses are bad. Yeah, which is not true. I've seen warehouses who are better.
Thank you.
Yeah, warehouses who are better in terms of quality than a high-rise or what we call a class 1 risk. But it's the exception, not the norm. Okay, so it depends on warehouses, and it depends also on the type of storage. So if you're installing or if you're storing combustible or hazardous material in the warehouse, okay, then it makes the exposure significantly high. If you're installing cotton, textile, and the like, then the exposure is significantly high. There are certain critical storages. If you're installing pharmaceutical products and medicines, then any small fire, you'd have a total loss.
Yes.
So it depends on the storage, but I agree. Not all warehouses are bad. They have to be carefully underwritten, and they have to be carefully considered and priced. With regards to the risk engineer report, I must say that I am not the expert, so I could give you my view from a treaty underwriter perspective, but we have a designated risk engineer in-house here in Bahrain who could share with you better underwriting aspects as to what exactly do we look like and what would be an ideal or a complete risk engineer report for us before we write any engineering business. Again, if you're interested, I could send you some information.
Thank you so much. Thank you so
as
much.
well, allow me to add one thing. If there is a lot of interest in a specific topic, we would appreciate as well to hear your feedback. Maybe we can arrange another session covering that topic.
That could be done as well, yes.
Yes, please do that.
Hi, everyone.
Hello.
Hello, my name is Amjad Abdel Fattah. I'm from General Gulf Cooperative Insurance Company. First of all, I'd like to extend my gratitude to Chedid and Fadil and Mr. Eli and Mrs. Maisa for this session. Indeed, it was very beneficial, and I think most of us agree that we will be walking out from this session with some useful knowledge. I have a question regarding the treaty structuring for quota share specifically. For a company that intends to increase their capacity and retention, what would be the major factors that you will look into, and what would you advise companies that are intending to increase their capacity? What they should do in order to have a larger capacity from the year before? Thanks very much, and Ramadan Kareem to all of you.
Thank you very much. Thank you. So yeah, the issue of capacity in general, I don't know, maybe Maisa would be able to add a little bit more. But the issue of capacity, reinsurers, we do not shy from giving capacity where it makes sense. This is what we do for a living. Reinsurers provide capacity. Okay. Now, generally, you would need to, or we all would need to factor many things: the portfolio, the business profile, the business plan, and the current market conditions as well. As if you ask me as a preference, we as reinsurers, we prefer non-proportional because we don't have to follow the fortune of the market blindly. And this is a part where we could price adequately to the best of our knowledge. In proportional, we prefer generally a quota share because in a quota share there is no element of adverse selection or anti-selection. We share everything from ground up. And but typically what you would see, you would find a quota share with a retention protected by an excess of loss and a surplus that sits on top of the retention. As a rule of thumb, if you ask me, this is a general question, assuming everything else, the market indications requiring capacity, the capacity and the income is justified, and the business plan is supporting the capacity request, an alignment of interest and a sizable retention level would give reinsurers generally better comfort that this company is confident in their business, they are willing to return. This is a sign of alignment of interest.
Okay, thank you very much.
Thank you, sir.
Any other questions?
Hello everyone. I would like myself Kashif Jamal from Al Raji Takaful. I would like to thank you, Chedid and Mr. Fadil Hanover, on behalf of Al Raji Takaful. I have a small question, very simple one. Maybe I'm lack of that. Regarding quota share again, quota share structure, surplus structure. Is there any method of calculation for calculating a layer, size of layer? Because what I have seen in my experience, the surplus is the same layers or the number of layers what is there in quota share retention. It is a multiplication of the layer.
Yes.
Same as quota share. So is there any method of calculation over there, or it can be a different, like 15 million as a quota share and 25 million or 50 million as a surplus, or it has to follow the quota share layer?
Thank you. Yes, the surplus is always expressed as multiples of the retention. So generally in the quota share, if you have a quota share and a surplus that sits above the quota share, for a company to have full access to the surplus capacity, they would need to utilize the quota share fully. If the quota share line size, the 100% quota share is $1 million, then and they have 5 lines of surplus, i.e. $5 million, to be able to have access to the $5 million surplus capacity, they would need to use the quota share up to $1 million. So the surplus is always multiple of the quota share, and you'd see in many treaties that there is usually a minimum. So you'd say, okay, to reduce anti-selection, the minimum cession to the quota share is 90% of applicable capacity. So if the applicable limit of the quota share is $1 million, then the company has to utilize at least 900,000 before utilizing the surplus. This is to ensure, again, the alignment of interest. Yeah, that yes, the quota share is ceded fully. So if it's a good business, we share it proportionally, the quota share and the quota share reinsurer and the insurance company, before it goes to the surplus. So it's only a general expression of capacity when it comes to surplus. Surplus is always multiples of the line size, be it even if you have, whether you have a quota share or you don't, the surplus only would be just multiples of the line. It could be a fixed amount, an even amount, like 1 or 2 lines, or it could be 1.5, 1.25. But for the sake of simplicity, accounting, etc., session purposes, claim allocation, risk allocation, generally insurance companies and reinsurers, they prefer an even number, 1, 2, 3, 4.
Thank you, everyone. This is Mustafa Adam. I would like to have a quick question here from Tawniya, Mustafa Adam from Tawniya. Could you, Mr. Fadil, repeat about the point triangulated losses, and also regarding the Pareto rating? Could you share with us the pricing tool or the formula?
Sorry, the first question is triangulated losses, yes? And the second question?
The Pareto rating.
Yes.
Normally, yeah. Normally in Saudi Arabia market, we don't use it here. Reinsurance broker mostly using it in this region. So it will be great if you can elaborate on these 2 points.
Yes. The triangulated losses, yes, we would need to index losses. Index losses as in bring them to today's values. Okay, so if you have a loss that occurred in 2000, okay, if this loss occurs today, what would be the cost of claim? What would be the cost of loss? And for that, we'd have to factor naturally inflation, change in tariffs. Today there is a tariff, yesterday there was no tariff, so all of that we would need to factor for the data to be ready or reliable for the pricing. Again, I think Eli would have a lot of material, I think, on indexation and triangulation as well. Maybe Chedid could share specific material. I'm happy to do so. Pareto, yes, Pareto. I cannot share the tool as such, otherwise I'll be losing my job. But I could share some of the background. So what are the basic principles, as in the mathematics behind the Pareto curve, that I could possibly share.
Will be great. Maybe later on with the certificate, Chedid can share it with us, or how we can arrange this, Mr. Eli?
I'll coordinate with our partners in Chedid.
Yeah, for sure, definitely, we can share this.
Thank you.
Sorry for interrupting, Mr. Fadil. Can you please confirm your email is Fadil dot, or it's not clear in the picture?
Okay.
Is it Fadil dot al?
AL-SABEA.
Okay, great. Thank you so much.
Thank you, sir. Eli?
Any other question, gentlemen? Or should we call it off for tonight before the sahur? There's still some time.
Thank you, Mr. El.
Okay. Again, we thank you again for Fadil for his time and for the excellent presentation. Thank you as well, Maisa, for your time and for the presentation.
Thank you.
We'll definitely be looking forward, hopefully, to meet you all again soon in another topic. Meanwhile, any topic you're interested in, I already took notes of the ideas you've mentioned, how we can elaborate on in further discussions. And at the same time, you do have the email of Fadil, and you do have as well the email of Hussam, our colleague, who did send you the invitations. So anything you would like to know more about, just drop Hussam an email. We'll filter all your interest. We'll check where you have more interest in which topic, and we'll arrange for another as well training. Thank you, everyone.
Great. Thank you very much.
Thank you. Thank you, Eli. Thank you, Mr. Thank you, Fadil.
Thank you.
Thank you.